next up is Michael from Chorus One, and he will be giving a talk about validator-driven MEV on app chains and beyond. Please welcome Michael on the stage.
Okay, hi guys. Hello everybody. I hope you can hear me okay. So I'm Michael. I'm head of research at Chorus One. We are validator. We have around $1 billion in stake. We are pretty big in the Cosmos, so some of you guys might stake with us. I would say we're also big on the Cosmos, so we do a lot of research in that ecosystem. And MEV really is a topic that has gained relevance for us in the last couple of months. And the goal of this talk is just to share why MEV is important to a validator, how validators think about MEV, and then what validator-driven MEV could look like, okay? And I'll look at two cases. One is an app chain case, and then the second would be a general purpose chain. And I'll give some examples for both. Now, before I dive in, because we have a fair amount of stuff to get through, I want to give a quick shout out to my co-author, who I made this presentation with, and who I work with quite a bit. His name is Umberto. He's on his honeymoon, so he's excused. But in any case, he contributed quite a bit to this entire piece. Okay, so here's the agenda for today. I'll start off by defining validator-driven MEV. Then I'll give a few words around our MEV journey and what made us dive in. I'll talk about MEV on app and general purpose chains and how a validator would think about both of these. And then I'll walk through a technical case, which is basically cross-chain MEV. Does it make sense? What do the incentives look like? What do you do as a validator? And then we'll conclude by just highlighting some of the potential risks that could come with the incentives potentially created by cross-chain MEV. Okay, so let's dive in. Why did we decide to dive into MEV? Okay, so validation, it's a pretty big business now. The staking economy has distributed $12 billion in rewards since kind of the advent of proof of stake, which of course was pioneered by the Cosmos SDK and Tendermint stack. And then staking rewards generally have three components. Okay, so you have component one, which would be inflationary rewards or token issuance. You have component two, which would be gas fees or transaction fees. And lastly, your third component is MEV, okay? And we have a little box there, which just says MEV is the only one of these components which you have some discretionary influence over. Transaction fees, you're not gonna affect. Token issuance, it's a parameter, you're not gonna affect it. MEV, there's some stuff you can do, okay? Who's capturing MEV? Well, there's really two worlds. One would be a dystopic type world, where I would characterize it just with the word centralization. Okay, in this world, MEV is captured by searchers and a few validators. So a classic example here would be a block builder co-locating with a validator on Ethereum. And that's kind of what you would want to avoid, because it turns MEV into a zero-sum game, and it really shrinks the pie for everybody. And we contrast that with a kind of utopic world, where MEV really is distributed across the value chain, and incentivizes everybody that adds value to a given ecosystem. Okay, so Osmosis is kind of at the forefront there with ProtoRef. Like an app could capture it, right? Delegators would see some of that. Searchers might be incentivized as well, but really everybody that contributes value takes a share, a slice of this pie. Our MEV journey so far, so we actually received a grant by DYDX to draft an in-depth report on validator-driven MEV on DYDX V4. So DYDX, that's our colleagues presenting on the main stage just now. We'll have that grant out in early August, and we feel pretty proud of it, so be sure to check that out. We also open sourced a Solana client with integrated MEV functionality, so it does some arbitrage, right, for a couple of routes, triangular, starting and ending with USDC. We actually published the first public tracker of MEV on Osmosis. Check it out on Twitter, it's at Chorus1MEV. We were slightly earlier than Skip by around 48 hours. But really, the tracker is retired now. Since Skip released ProtoRev and MEV revenue osmosis is kind of being owned by the protocol. We're also pretty opinionated on Ethereum validator location and relays, and I'll show you a graph in a second. And lastly, we just published a lot across the board. So if you look at our blog, you'll see some articles on MEV on Solana. You'll see a couple of Dune dashboards linked that might be interesting for you, so be sure to take a look at that. Taxonomy of validator-driven MEV. Okay, there's basically two worlds. One is the general purpose chain world, and then we have the app chain world. In the general purpose chain world, what usually happens is the problem space is a bit too large to really search yourself, right? MEV is very tail heavy, so some protocol suffers a hack, and suddenly there's a big opportunity spike. But if you're an in-house team, you probably don't have it covered, right? Because you just don't have the resources to cover the entire universe of what's out there on a general purpose chain. For that reason, as a validator, the way you would handle that is you would just optimize the way you interact with the existing MEV value chain. So on Ethereum, for example, that would be things like optimizing location and latency. Some of you guys might have read Barnaby's paper on latency games. That's something we feel quite opinionated on. Partner selection, relay selection, and then lastly risk adjustment. Okay, because some relays might carry more risks than others, and in that case you want to reflect that in terms of who your validator takes a block from. Okay, the app chain world really is a bit different. The problem space is way more limited, and transaction behavior is generally hard-coded and quite clearly defined, right? So there you have two challenges. One is on-venue, and the other would be cross-venue type MEV. Let me talk about on-venue for a second, and then we'll dive into cross-venue with some more depth. For on-venue, you can hard-code strategies, and typically they would persist, because people are wary of updating the chain to such an extent that would break lots of integrations, right? So once you have something hard-coded, it should usually be fine for a while. Inventory management is, of course, way simpler if you just have one venue. And then it's also quite easy to maintain. And here I'm just assuming we are talking about the Cosmos SDK stack, right, which we know quite well and which is pretty well suited to being adjusted. Yeah, and then lastly, ProtoRev just proves it, right? This is something that works on app chains. If the incentives are there as a validator, you can dive in, and that's something you can do. Cross-venue really is a much more difficult problem space, because if you're a classic validator, you're not going to be competitive on speed and fees on centralized exchanges, okay? You just don't run the volume to where you would get fees that would allow you to take a lot of opportunities. Inventory management, that's going to be way more complex, and of course, there'll also be some risks that come with that. Then the other way you can look at it is, fine, I'll forget about the centralized exchange, right? That's a validator, that's really not my game. I'll just arbitrage two different chains against each other. Yeah, and here the question is just, are the incentives there? So let's take a look. Yeah, and we just quickly wanted to show that graph. We mentioned before that we are quite opinionated on relays on Ethereum. So you'll see two curves here. The bottom curve is the weighted LIDO average in terms of cumulative MEV rewards. And then the top curve, that's our curve, Chorus 1 curve. This is third-party data. It comes from rated.network, which is a service that we use a lot and recommend. And I should highlight that this is not a smooth curve, right? So we run a number of validators that makes this curve quite smooth, and we feel good around the extent of variance that we have, just because our validator set is so large that lots of things get smoothed out. Now, in terms of cross-chain MEV, okay, so this is where the talk becomes slightly technical. Really, a couple of conditions would have to be filled before you can run to exploit a cross-chain opportunity. And let me start with the first condition here, which would be selection. Okay, if you want to do validator-driven cross-chain MEV, you'd need to propose on both chains. Let's recap the assumptions here. Okay, so we assume that we have two chains with differing block times. Those are basically averages that you would commonly see in the Cosmos ecosystem. And let's say that you have a large validator that has 8% of the vote on each of those chains. And that really is a very, very optimistic assumption, right? typically you would have less than 8%, and you'd need to be pretty large to come anywhere close to that. So the first thing you would look at is just the probability to be selected as the proposer on both chains. The formula is here. If somebody is interested in that, talk to me after. I'll send you the presentation. You can dive into it. In any case, that probability is just to say that the curve on the top here gives you an average of 219 slots. Okay, that would overlap in a typical week between chains with these block times. That's not a lot. So the next question then is, of course, are MEV opportunities big enough to where just that limited amount of opportunity would already pay off? And I want to close that slide by highlighting a quick limitation, and that is the bottom graph here, block time distribution. That really varies a lot depending on the weight the chain is under, right? So if there's lots of transactions and there's lots of volatility in the system, your block time would change accordingly. And that, of course, also corresponds with MEV opportunities, right? So if there's a lot of volatility in the system, block times would tend to be longer, which in turn would mean that you get less of those valuable slots in situations where the opportunity would probably be particularly attractive. So that's important to note here as well. So really, it's a very, very optimistic case. Opportunity. How big is the opportunity? Let's again start by looking at the assumptions. We use the pre-proto-rev osmosis MEV numbers as a proxy for both chains, basically the distribution of MEV opportunities that osmosis had before proto-rev come in. And then we make an assumption with just whenever there's an opportunity and the validator proposes, the validator hits it every single time, which is of course also quite optimistic, but I think it will help illustrate this case. Okay, so there's some metrics on the sample here. I'll just cut it short by saying your mean per block payoff before proto-rev, that was 12 cents, okay? And then your median per block payoff, that was actually 0. So again, that just speaks to the fact that these opportunities, they're very, very tail heavy. And in a median block, you really wouldn't expect to see a typical opportunity. Okay, so if we take these assumptions, and by the way, the top graph here shows you the per block MEV opportunity as a cumulative distribution function. So you see it really starts to flatten a lot once you get to like $1. So it's not particularly big. And the upshot of that is, so the opportunity would be less than $1 with a probability that we would estimate around 90%, okay? And that's with these very, very liberal assumptions. And this, of course, falls quite short of validator cost, okay? And I think the best way of saying it is if you check out the bottom graph here, which is just a zoom in on the weekly cross-chain MEV opportunity size, okay? For a validator with 8% of the vote, again, on one chain with around 6 seconds and one chain with around 5-second block times. Yeah, so the question is that because we're in a bear market, or will this opportunity really grow once volume comes back? So we'll look some into that in the last slide. Yeah, profit, question mark. That's the question. So we'll assume an alternative MEV distribution where 70% of the blocks now include an MEV opportunity. Okay, the opportunity size would again correspond to the actual MEV distribution on osmosis, but we'll just increase the payoff by a solid 100x. Because really what we want to show you is just arbitraging two chains as a validator. That probably doesn't make a lot of sense currently. This distribution is highly overstated. On pre-proto-rev osmosis, you would expect MEV to come in at around 0.01% of traded volume. So our distribution would really imply a trading volume of 56.11 billion, okay, in a week. And that would exceed the total trade volume on Ethereum. So that's probably not going to happen anytime soon. And again, it implies a median per block payoff of $1.15, and the mean would be $60. So you can see that that kind of just implies massive transactions taking place. So let's assume that maintaining a custom client on both of these chains, you're going to need 3 full-time engineers, right? Or let's call it 1 full-time engineer and 2 searchers. And that would cost you around 400K. So even with that kind of overstated distribution, the weekly payoff curve, which you can see at the bottom there, would say that you would usually expect to earn less than 8K, even if you have more volume than Ethereum. So even if you hit that every single week, you really just start to cover your costs. And for that reason, and that's one conclusion, we are really not worried about validator-driven cross-chain MEV in the foreseeable future. There are exceptions. If you have many chains which have different volumes, then the mesh of chains, that increases your opportunity size massively. But really, the way it is right now in the Cosmos is that your network, like your swap exchange topology, just reduces to a couple of small venues. So we feel good about just assuming two chains at this point in time, because it feels like something that's consistent with practice. And let me just close by outlining some of the risks that might come with cross-chain MEV ever gaining more relevance. Well, your first risk, and some of you might have seen Antonio's tweet the other day, around slashing on DYDX before, and again, check out our paper once that comes out in early August, is that if you have a custom validation client, it probably runs a higher risk of incurring a penalty because it does something that's non-standard. And it does something that, you know, some people might not feel as good about. And if you have a slashing risk, as a validator, you self-bond, let's say you self-bond 5%, or it might even be 10%. But really, the overwhelming majority of your stake, that comes from delegators. So you're imposing that slashing risk on delegators. And we don't feel certain that the additional revenue you would earn, that would be able to cover the slashing risk. So if you're a delegator and you're rational, you wouldn't want to stake with a validator that imposes excess risk on you for returns which might only be marginally better. Then there's an uneven opportunity set. Let's assume that opportunities would be distributed unevenly between chains, which I think is a fair assumption. You'll always have some exchanges which have better flow or more flow or less liquidity, something that just makes them more prone to MEV extraction. That means if you're a delegator, you are incentivized to kind of stake on the chain, producing MEV opportunities at a higher rate than others. So capital would be attracted to this chain. And more specifically, capital would be attracted to the validator that's most savvy in terms of capturing this value. So basically what ends up happening, it decreases the security of other chains, and you kind of start to incentivize MEV leakage a little bit, because that's what really would attract capital in a world where MEV leakage translates into higher staking rewards. And then last point I want to highlight is additional APR. APR is a very straightforward number, and many people really optimize for APR without taking into account tail risks. So if you're a validator and you can increase APR, potentially at the chance of running some more risk, people will not allocate as much perceived risk to that as they probably should, right? Tail risks can take time to manifest. So as a validator, you would really be incentivized to do things that you might not feel really would pay off in the very long run. And validators that engage in such risky behavior, they would attract a disproportionate amount of stake. And I think we've seen several similar scenarios in crypto a couple of times, right? Like the whole Luna UST 20%. Okay, so people tend to not take risks into account as much as you would often wish. So that again would increase centralization, and it would increase centralization specifically for players that we would perceive as more risky. It would also create moats, and that you don't really know what any of these places might do. And lastly, it kind of kickstarts a positive feedback loop, because they then would have higher budgets. And with that, I'll conclude the presentation. Thanks for listening. Any questions, find me afterwards. We have a booth over there. Yeah, that's it. Thanks.